Look, I know talking about death isn't exactly fun, but here's something that might surprise you. Over 35% of Americans have absolutely no idea what happens to their retirement accounts when they die. And that lack of planning, it's costing families billions of dollars in unnecessary taxes and creating legal nightmares that can take years to sort out. So today, we're going to walk through exactly what happens to your 401k, IRA, and other retirement accounts after you're gone. More importantly, I'm going to show you the critical mistakes that could cost your family up to 50% of what you've spent decades building and how to avoid them. This isn't about being morbid. It's about making sure the people you love actually get the money you worked so hard to save. Let's dive in. The beneficiary decision tree. Here's the thing most people don't realize. Your will doesn't control your retirement accounts. Let me say that again because it's crucial. Your will does not control your 401k or IRA. Instead, these accounts pass directly to whoever you named as your beneficiary on the actual account forms. And if you're thinking, well, I filled that out when I opened the account 15 years ago, we need to talk. So let's break down what happens in different scenarios. Scenario 1. You named your spouse as beneficiary. This is actually the most flexible option. Your spouse has choices that nobody else gets. They can treat the inherited IRA as their own, which means they can delay distributions until they're 73, or they can keep it as an inherited IRA, which might make sense if they're under 59 and a half and need the money without paying that 10% early withdrawal penalty. Here's why this matters. If your spouse is 55 and you die, they might need that money to live on. If they roll it into their own IRA and take money out, they'll get hit with that early withdrawal penalty. But if they keep it as an inherited IRA, they can access the funds penalty-free. Then, once they hit 59 and a half, they can roll it into their own IRA and get all those other benefits. Scenario 2, you named your adult children. This is where things changed dramatically in 2020 with the Secure Act. Used to be your kids could stretch those distributions over their entire lifetime, paying minimal taxes each year. Now, they have to empty the account within 10 years, and depending on when you died and whether you'd already started taking required minimum distributions, they might need to take annual withdrawals during those 10 years, or they could wait and take it all in year 10. Scenario 3, you never updated your beneficiary form. This is where families end up in court. If there's no beneficiary listed or your beneficiary is deceased, that retirement account goes to your estate. That means it goes through probate, which means legal fees, delays that can stretch for months or even years, and your creditors get first dibs before your family sees a penny. I've seen cases where families lost 20 to 30% of the account value just to legal fees and estate costs. The tax torpedo. Now let's talk about the thing that catches most families completely off guard, the tax bill. Here's what a lot of people don't understand. When you put money into a traditional 401k or IRA, you got a tax deduction. That was nice, right? But Uncle Sam hasn't forgotten. He's just been patient, and when you die, he's ready to collect. Every dollar your beneficiaries withdraw from that inherited retirement account, it's taxed as ordinary income at their tax rate in the year they take it out. Let me give you a real example. Say you leave your daughter a $500,000 IRA. She's a successful professional making $150,000 a year. Under the 10-year rule, she decides to take out $50,000 a year. That bumps her income to $200,000, pushing her into a higher tax bracket. She could easily lose 30 to 35% of each withdrawal to federal and state taxes. But here's where it gets worse. If she's not careful with the timing, she could trigger additional taxes on her Social Security benefits, Medicare premium surcharges, and lose eligibility for certain deductions and credits. There's something called the tax torpedo, where each additional dollar of income doesn't just get taxed at your marginal rate, it can trigger a cascade of other tax consequences. The brutal reality, a $500,000 inheritance could become $325,000. That's $175,000 gone like that. Now, there is a strategy to minimize this damage. If your beneficiary is strategic, they can spread out the withdrawals in lower income years. Maybe they take a larger distribution in a year when they're between jobs, or when they're planning to retire in a few years and can wait to take larger distributions then when they're in a lower bracket. But here's the problem. Most people don't think about this until it's too late. Your daughter gets that inheritance notification, she's grieving, dealing with 1,000 other things, and she just takes the money out when she needs it without considering the tax planning opportunities. By the time she talks to a tax professional, she's already locked in those high tax withdrawals. This is why having these conversations now while you're alive is so critical. You can help your beneficiaries understand the tax landscape they'll be navigating. The Roth conversion secret. This brings me to one of the most powerful estate planning moves most people never consider: Roth conversions. Here's the play. While you're alive, you convert portions of your traditional IRA to a Roth IRA. Yes, you'll pay taxes on the conversion, but here's the beautiful part. Once that money's in a Roth, it grows tax-free forever. And when your beneficiaries inherit a Roth IRA, they still have to follow that 10-year rule, but they can withdraw the money completely tax-free. Let me show you the math. Say you're 60 years old with a $400,000 traditional IRA. Over the next 10 years, you systematically convert $40,000 per year to a Roth, paying taxes at your current rate, let's say 22%. So you're paying about $8,800 per year, or $88,000 total. By the time you're 70, assuming modest 6% annual growth, you might have $600,000 in that Roth. When your kids inherit it, they can pull out $60,000 a year for 10 years, or $600,000 total, and pay zero taxes. Compare that to inheriting a traditional IRA where they might be paying 32% or more in their peak earning years. That would be over $190,000 in taxes. You paid $88,000 at your rate. They saved $190,000. That's a net benefit of over $100,000 to your family just from smart planning. Now, Roth conversions aren't right for everyone. If you're going to need that money in retirement and you'll be in a low tax bracket, it might not make sense. But if you've got more than enough to live on and you want to maximize what goes to your heirs, this is one of the most powerful tools available. And here's a bonus. Roth IRAs don't have required minimum distributions during your lifetime, so that money can keep growing tax-free for decades if you don't need it. The spouse versus non-spouse trap. Here's another critical distinction that trips people up. The rules are completely different depending on whether your beneficiary is your spouse or not. We touched on this earlier, but it's so important it deserves emphasis. Spouses get special treatment. They can roll that inherited IRA into their own IRA, delay distributions, name their own beneficiaries, and basically treat it like it was always theirs. Non-spouse beneficiaries, they don't get any of that. They're stuck with that 10-year clock. They can't do rollovers, and they generally can't name their own beneficiaries if they die before emptying the account. And here's a mistake I see all the time. People name their adult children as primary beneficiaries instead of their spouses, thinking they're being fair or protecting the kids in case of remarriage. But this can backfire spectacularly because those kids lose all the flexible options a spouse would have had. Let me give you an example of how this can go wrong. John and Mary are married. John has a $600,000 IRA. He's worried that if he dies and Mary remarries, his kids from a previous publishing won't get the money, so he names his two adult kids as 50-50 beneficiaries. John dies at 68. His kids are both in their 40s, in their peak earning years. They each inherit $300,000 and have to empty those accounts within 10 years. Between federal and state taxes at their high rates, they each might lose $100,000 or more to taxes. If John had named Mary the primary beneficiary, she could have rolled it into her own IRA, let it continue growing tax-deferred for another 10, 15 years, and then left it to the kids. Or she could have done strategic Roth conversions over those years, paying taxes at her lower rate. There's a better way to handle this concern. You can name your spouse as primary beneficiary and your kids as contingent beneficiaries. Or you can use a trust, which brings me to another important point. Some people do need to name a trust as beneficiary, especially if you have a beneficiary with special needs who receives government benefits, someone with creditor issues, or someone who's just not financially responsible. If your 30-year-old son has a gambling problem, leaving him a $400,000 IRA outright might not be the best idea.
But trusts and retirement accounts can be complicated. The trust needs to be structured correctly as a see-through or conduit trust, or you could accidentally trigger immediate taxation of the entire account. This is definitely a situation where you need professional help from an estate planning attorney who specializes in retirement accounts. The multiple beneficiary complication. Here's something that doesn't get talked about enough. What happens when you name multiple beneficiaries and their different ages or types? Let's say you name your spouse and your 2 children as equal beneficiaries, 1/3 each. Or maybe you name your 3 kids, but one is 45, one is 35, and one is 25. The rules get messy fast. If the beneficiaries are different types, like a spouse and a non-spouse, the most restrictive rules generally apply unless the account is split into separate inherited IRAs by December 31st of the year following your death. So if you die in 2026, they have until December 31st, 2027 to split it. Here's why this matters. Let's say you leave your IRA to your 70-year-old spouse and your 40-year-old daughter
50-50. If they don't split the account, your spouse loses their special rollover privileges and gets stuck with the 10-year rule along with your daughter. But if they do split it properly, your spouse gets their full set of options and your daughter gets her separate inherited IRA with the 10-year rule. The same thing applies with multiple children of different ages. If you have 3 kids and you want to leave them equal shares, that's great. But make sure your beneficiary designation is clear and make sure they know they need to split the account into separate inherited IRAs immediately. I've seen families where one kid needed the money right away, took big distributions and paid huge taxes, while the others wanted to let it grow. But because they didn't split the account properly, they all got tangled up in each other's decisions. Another thing, be really careful about naming minor children as beneficiaries. If a minor inherits a retirement account, it typically requires a court-appointed guardian to manage it until they reach adulthood, which means legal fees and court supervision. For minor children, a trust is usually a much better option. The forgotten accounts problem. Here's something that should terrify you. There's currently over $1.5 billion sitting in unclaimed retirement accounts in the United States, and that number is growing every year. People change jobs, roll over accounts, open new IRAs, and then forget to update beneficiaries. Or they die and their families have no idea these accounts even exist. I spoke with a woman recently whose father passed away. They knew about his main 401k from his last job, but 6 months later, they discovered he had 3 other retirement accounts from previous employers that they'd never known about. Tracking them down became a part-time job. Here's another real scenario. You got divorced 15 years ago. You updated the beneficiary on your main IRA, but you forgot about that old 401k from a job you left 20 years ago. Guess what? Your ex-spouse is probably still the beneficiary, and depending on your state's laws, they might actually get that money even though you've been remarried for a decade. I'm going to give you a homework assignment right now. Pull out your phone, right now. Go to your email and search for every financial institution you've ever worked with. Search for 401k, retirement, IRA, anything like that. Make a list. Then, this week, contact each one and verify 1. Who is listed as your primary beneficiary? 2. Who is your contingent beneficiary in case your primary beneficiary dies before you? 3. Are those people still alive and are they still who you want inheriting this money? And keep that list somewhere your family can find it. Better yet, tell your spouse or trusted family member exactly which accounts you have and where. Create a document with account numbers, financial institution names, contact information, and approximate balances. Update it every year. Some people keep this in a safe deposit box, some use a password manager, some just keep a sealed envelope with their estate planning documents. It doesn't matter how you do it, just make sure someone will be able to find this information when they need it. Look, I know this isn't the most exciting topic, but here's the reality. You've spent decades contributing to these accounts, watching them grow, planning for retirement. Don't let poor planning destroy that legacy. Check your beneficiaries today. Consider whether Roth conversions make sense for you. Talk to your family about where your accounts are. Make sure you understand the rules for different types of beneficiaries. And if your situation's complicated, if you have minor children, special needs beneficiaries, or blended family concerns, talk to a financial advisor or estate planning attorney who can help you navigate this properly.
Because the difference between planning and not planning isn't just about money. It's about whether you're leaving your family a gift or a burden. It's about whether your life's work goes to your loved ones or to the IRS and lawyers. If this video helped you, hit that like button and subscribe for more real talk about money. Drop a comment and let me know, when was the last time you checked your beneficiary designations? I'm genuinely curious. And if you've got questions about your specific situation, drop those too. I read every comment. Thanks for watching, and I'll see you in the next one.